think they're going to cut rates, and I think they're going to cut rates sooner than people expect, because what's happening is the real rate of interest, ultimately, which is what impacts the economy, keeps increasing as inflation declines, right? So if the Fed keeps rates in the sort of middle fives, and inflation is trending below 3%, or that's a very high real rate of interest, and I think that is having a sort of retarding effect on the economy. And then, of course, again, many businesses and certainly many individuals have the benefit of fixed rate debt. And that fixed rate debt, certainly for companies and for commercial real estate, starts to roll off. So I think there's a risk of a hard landing if the Fed doesn't start cutting rates pretty soon. So I think the market expects sometime middle of next year. I think it's more likely probably as early as Q1.
The legendary billionaire investor Bill Ackman expects rate cuts in the first quarter of 2024, emphasizing the risk of a hard landing with or without them. The founder and CEO of Parsing Square Capital Management boasts a net worth of whopping $4 billion. But what sets him apart is his uncanny ability to make strategic moves that send shockwaves through the market. Remember when Ackman predicted the economic shutdown triggered by the onset of the COVID-19 pandemic? Oh, he didn't just predict it. He made a jaw-dropping 100-fold profit by cleverly hedging his investments with credit default swaps. Fast forward to October, and he's pocketing $200 million from shorting U.S. Treasuries. This man's got the most touch when it comes to market timing, but now Ackman isn't just making headlines, he's making accurate predictions that can significantly impact your portfolio. In late November, he boldly declared that the Federal Reserve would start slashing the federal funds rate by the first quarter of 2024. And guess what? The Federal Reserve just unveiled a dovish stance confirming Ackman's foresight. Chairman Jerome Powell even hinted that the current macroeconomic indicators might be a sign that the economy is normalizing and doesn't need a tight policy. Now, why does this matter to you? Well, historically, businesses have thrived during rate cuts, and that's where our focus lies today. In this video, we're about to unveil 3 stocks that have consistently benefited during rate cut times, outperforming the market and potentially lining your pockets with handsome returns. So let's get started. First on the list is none other than the visionary Elon Musk's brainchild, Tesla Inc., ticker symbol TSLA. Elon Musk, the maverick himself, has been vocal about the challenges of high interest rates, making electric vehicles seem like a distant dream for many. But here's where the tide turns. As the Federal Reserve gears up for potential rate cuts, the affordability of Tesla's game-changing electric vehicles is expected to get a major boost. With most folks juggling paycheck-to-paycheck lifestyles and battling credit card debt, lower interest rates could be the magic potion that makes Tesla's vehicles not just a dream, but a reality for many. Now let's talk numbers, and boy do they speak volumes. Despite the surface-level concerns about Tesla's valuation, the company financial picture is robust, with a forward PE ratio hovering around 80. And you might raise an eyebrow, but consider this: historical multiples and the promise of future operating margin expansion, potentially exceeding 50%, could justify this valuation in the long run. But wait, there's more. Enter the Cybertruck, Tesla futuristic beast that's set to dominate the pickup truck scene. Production estimates, reservations, and juicy details about this stainless steel marvel are sending shockwaves through the market. Even with recent recalls and production challenges, the demand for the Cybertruck seems insatiable. Here's the game changer: the Cybertruck potential production capacity of 125,000 units annually by 2025, with an average price tag of $80,000, translate to a whopping $10 billion in revenue. And that's just the tip of the iceberg. Despite short-term profitability concerns and the volatility in operating income, the long-term potential of the Cybertruck is a revenue powerhouse is hard to ignore. Sure, there are risks, and Elon Musk himself acknowledges the hurdles in achieving volume production. But as the company refines its autonomous driving strategies and stabilizes Cybertruck production, we believe that the rewards will far outweigh the challenges. So if you've been eyeing Tesla from the sidelines, now might just be the perfect moment to jump in. With visionary leadership, groundbreaking technology, and a future-driven outlook, Tesla is not just a car company, it's a revolutionary force that could reshape the automotive landscape. Now we're zooming into the dynamic world of Google parent company Alphabet Inc., ticker symbol GOOGL. Alphabet, the behemoth and Ackman portfolio, boasts a staggering valuation of $1.2 billion, with 4.35 million of Alphabet Class A voting shares valued at nearly $570 million. Ackman is doubling down on a company that's gearing up for a tech revolution. Alphabet faced some headwinds in the past year playing catch-up in the artificial intelligence arena. But fear not, because Google has its eyes set on the prize. In the ever-evolving AI landscape, Alphabet has been making aggressive moves, and the game changer is none other than Gemini AI. Unveiled on December 6th, Gemini AI is Alphabet's state-of-the-art artificial intelligence model that's not just closing the gap but setting new benchmarks in AI capabilities. Designed to analyze diverse data forms, including video, audio, and text, Gemini stands tall as a multimodal AI, setting it apart from the crowd. But here's where the magic happens. Gemini is not just a model, it's a game changer. From Ultra for intricate tasks, Pro for versatile applications, to Nano for efficient on-device operations, Gemini is like a Swiss Army knife for AI. It's not just versatile, it's a powerhouse that can generate code, combine text and images, and perform visual reasoning across languages. The possibilities are limitless. And the performance, well, hold on to your seats, because Gemini is smashing benchmarks left and right with a remarkable score of 90%. On the massive multitask language understanding benchmark, Gemini outperforms human experts. It's not just catching up, it's taking the lead. But what about the competition, you ask? Google's Gemini is flexing its muscles against heavyweights like GPT, Claude from Anthropic, and Meta Llama. The numbers don't lie. Gemini is not just responding to the competitive landscape, it's redefining it. Now, let's talk strategy. Alphabet is not just stopping at Gemini. With aggressive investments in Anthropic AI and potential talks to acquire Character AI, Alphabet is playing chess in the world of AI, positioning itself as a major player in the future of technology. With Gemini foundational large language model, Alphabet is eyeing additional revenue through cloud training and inference. This, coupled with its robust financial position, places Alphabet in a league of its own. Despite regulatory scrutiny and the evolving tech landscape, Alphabet's valuation is narrowing the gap compared to its peers. With a forward EV to revenue in line with the FANG Group average, Alphabet is not just undervalued, it seems buy. Now our spotlight is finally on the heavyweight in construction and equipment, Caterpillar Inc. Ticker symbol CAT. Caterpillar has been turning heads, with its shares soaring over 22% year to date, hitting an all-time high of $293. That's not just impressive, that is a testament to Caterpillar resilience and strategic positioning in the market. While the Dow Jones Industrial Average, or DJI, has delivered a commendable 13.3% return, Caterpillar has outpaced, improving why it's a force to be reckoned with. One of the key drivers behind Caterpillar's stellar performance is the historical advantage that industrial stocks enjoy in lower interest rate environments. As interest rates take dip, construction activity in the economy gets a boost, and Caterpillar is right at the forefront, reaping the rewards. Analysts are anticipating a robust 6.4% year-over-year revenue growth for Caterpillar in the first quarter of 2024, signaling a promising trajectory. But that's not all. Caterpillar isn't just growth play, it's also a dividend aristocrat. With a track record of raising annual dividends for the past 30 years, Caterpillar stands tall as our reliable income generator, paying out $5.20 in dividends annually. The current yield sits at a solid 1.82% on its current share price. That's a sweet deal for investors seeking a blend of growth and income. Now let's dive into the nitty-gritty of Caterpillar financial metrics. When compared to its industry counterpart, Deere, Caterpillar shines in key areas. With better average net margin, return on assets, and return on equity, Caterpillar showcases its financial strength and operational efficiency. The quality of earnings, as evidenced by the cash flow from operations, or CFO, compared to earnings before interest and taxes, or EBIT, paints a picture of stability. With Caterpillar holding slight edge, Caterpillar demonstrates a robust cash conversion cycle, showcasing its efficiency in managing inventory, sales, and payables. While Deere might sell inventory faster, Caterpillar's strategic approach to dealer inventories aligns with stable demand, making it a smart play. Caterpillar, despite having the same total debt to capital ratio as Deere, manages to stay on top with lower long-term debt to equity. It's a testament to Caterpillar's prudent financial management.